The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. Thank you all so much for joining us today for our November webinar series titled Essential Strategies for a Successful Retirement. For those of you joining us for the first time, my name is Amanda Sylvia, and I am the Client Service Associate for Stonehearth Capital Management. I have been with Stonehearth for almost 4 years now, and my primary roles include client service, marketing, and compliance. I would like to start off with a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be monitoring all of your questions and will ask Jamie to answer as many as time allows at the end of the webinar. If we do run low on time and we are unable to get to all of them, Jamie or myself will reach out to you directly after the webinar to make sure that we get your question answered. So now I would like to introduce our speaker for today. Jamie Upson is Stonehearth's President and CEO. Jamie has been with us since 2000, and in the first couple of years here, he focused mostly on portfolio management, design, strategy, and product analysis. In 2006, he passed the CFP exam, and he spent the next 11 years at Stonehearth co-managing client portfolios and building, analyzing, and monitoring client financial plans. In 2017, Jamie purchased the firm, and he hopes to lead the firm forward and continue to help clients meet their financial goals. Jamie, thank you so much for joining us today.
Thank you very much, Amanda. Thank you, everybody, for attending today. This is obviously about retirement strategies that I'm going to focus on, an area that we've spent quite a bit of time analyzing and talking to families about. So I'm going to dive right in. As Amanda said, share your questions with us. Go ahead and enter them. I'm happy to address them if time allows at the end. If not, then what I'll do is I'll send you a note or I'll give you a call after. So we're going to start here. It really starts with when any new family comes on board. We always start with what is it that you plan? What do you envision for your retirement? Is it going to include traveling? Are there going to be vacation homes? Is there a particular passion that you have? Or are you going to stay local around the grandkids? So to everybody, to each their own. Everybody has their own vision of what that's going to look like. It is going to be a pretty big change. While there'll be a lot of similarities, we're going to wake up every day. We're going to eat every day. The fact that you're going to wake up and not necessarily have some place to go or have to go, that's going to be quite an adjustment. You can see this fellow that's on TV. He has no watch on his hand. I notice she does, but he doesn't. So there are going to be some things that are going to be different. One of the bigger areas that I think is an adjustment for a lot of families is that we go from an accumulation phase to a withdrawal phase. And everybody deals with that slightly different. Some people embrace retirement. Some people are very skeptical of it, or they approach it in a skeptical manner because it's new for them. It's something that they haven't done before, and they want to get it right. So as this says, our habits and attitudes about investing and spending money definitely could change. We go from accumulating assets, spending all of our time saving in 401ks, and increasing our savings into IRA accounts or Roth accounts, any way that we can, saving for children's education. And all of a sudden we go one day and all of a sudden the income's no longer going to come in through a salary. Maybe you've got a pension if you're fortunate enough, but those are going by the wayside. And so now we're going to actually turn this on its head and say we've got to take these portfolio assets that we've accumulated, spent our entire life accumulating, and we're going to start withdrawing money from them. And that can be a big overwhelming thing for families, and that's one of the areas that I'm going to address today is, well, where do you start? How do you even think about distributing these assets? I knew I used to receive, I don't know, $7,000 a month while I was working, and what am I going to need in retirement, and how do I start distributing those assets to me? You need your assets to be generating income, making the most of your hard-earned money. This is just opportunity costs. We don't want to just leave everything sitting in a money market because that'll struggle to keep pace with inflation and taxes, which I'll show you in a second, at least the inflationary side. And then there's the risk side of this equation when we're going through retirement. You gotta protect yourself. You gotta keep your guard up to some degree. There's a fine balance there, but you need to be able to protect your income. You need to be able to protect your assets, and we'll explore some of those areas towards the end. There are 5 basic areas that we go through. So when a new family joins us and they're preparing for retirement, we're basically taking an inventory of what they have. What's your income been? What assets do you have? Are there any projected inheritances that you're going to receive? What do your taxes look like? These are all the things, we call it the data gathering process. So let's dive into some of those areas. First, I want to look at some of the areas that are going to be some headwinds for people's situations. The good and the bad. The good news is that people are living longer, mostly due to medicine. Now at this point, most people can plan that they're going to live for 20 years if they retire at 65. And you can see here that a male has a 35% chance of making it to age 90, and almost half of women stand a chance of making it to age 90. This is why you have to plan out farther and farther, because some people will even make it past age 90. I was driving down south of Boston the other day, and one of the big firms, I don't know if it was Prudential, I forget who it was, but they said you need to start, they had a big billboard, and it said you need to start preparing for age 107, 107. And I don't know what age they were talking about, whether that's a newborn today or what have you, but I don't know. They're probably not that far off. That you need to start planning for a longer life expectancy, and in particular, retirement. Think about this. If you work for 30 to 40 years, we're now entering a phase where you might be retired for more than your working years. Hence, one of the challenges that Social Security is having with that equation. The next hurdle is going to be inflation. I think retirees understand inflation better than people that are working. I might be wrong on that, but when you're dealing with a finite fixed income, maybe your income has inflationary adjustments, but many don't, although I am happy to report Social Security does have inflation adjustments. Here you can see on the left-hand side, $1 million today. In 5 years, if we assume 4% inflation, that $1 million will only have the same purchasing power 5 years later of $820,000. Look at this one over here and 20 years later. So it's worth less than half in terms of your ability to use those funds to go out and buy goods and services. That is amazing. Jen and I just were meeting with a new family this morning. We were doing a financial plan, and we saw that today the living expenses were right around $50,000. And 50 years from now, that was going to equate to $200,000. And we used 3.74% inflation, so just a little bit less or lower than what they're projecting here, or at least what they're using in their calculations. So inflation is going to continue to be a headwind for many. And fortunately, today we've had pretty low inflation. It's been right around 2%. And we'll see where that goes. But in the early 80s, it used to be in the teens. So 2% is probably not realistic long term, nor is 13% like we saw in the early 80s. But somewhere around 4% is probably not that far off from the norm going forward. We'll see. For most people, they need about 70 to 80% of their pre-retirement income to live comfortably in retirement. So if I'm making $100,000 a year, I probably need to generate about $75,000 of income in retirement to live the same lifestyle that I was living while I worked. Some people have asked me, well, why does that drop off? Why isn't it 100%? Well, some of the bigger line items are you probably had been saving in a 401k or a retirement plan at work. And if you were doing, maxing out, that's $20,000 roughly. So that right there goes from $100,000 to $80,000. That if you're no longer saving in retirement, which you shouldn't be saving in retirement, then that $20,000 is going to be wiped out right away. So then we just need to live off of $80,000. Then you can also justify and say that taxes are usually lower when you're no longer working, and that is usually true. That's the other line item that helps reduce this need to replace 100% of your income, and that's why it looks closer to 70 or 80%. Your primary sources of retirement income, I would have normally put pensions on here, but again, pensions are going by the wayside. They've all been converted mostly to defined contribution 401k plans, which now puts the onus on you and I to save and manage and start distributing later on in life. This is why a presentation like this becomes super important, because more and more the emphasis to generate income and to utilize certain strategies in retirement is being put on your own shoulders to be able to navigate. Because traditionally, we were just, you worked for 40 years for a group, an organization, an employer, and they rewarded you for that service by equating that to a monthly income stream for you and sometimes your spouse. The first area is personal savings and investments. This is what we call your portfolio. So there are two major categories, the tax-deferred vehicles, and then you've got the taxable vehicles. The tax-deferred just means that taxes are being postponed, delayed, as another way of saying it. So 401ks, 403bs, 457 plans, those are the traditional ones. You can always also have 401as. Those are all employer-sponsored retirement plans where you don't pay taxes when the money's going in. You don't pay taxes while the money's still in the plan year after year, but you do start paying taxes when the money comes out of the plan, when you start distributing the money to yourself. Usually when people retire, they end up taking this money from the 401k and moving it over to an IRA account so that somebody like our firm could manage those assets at TD Ameritrade, Fidelity, Schwab, Pershing, one of the large institutions, because you go from an employer-sponsored plan that might have 20 or 30 investment options to a brokerage platform like an IRA offers, where you can have 20, 30,000 investment choices. Now, I acknowledge that that sounds like a lot, but for somebody like us, we want to have that 20 or 30,000 different products to choose from so we can get best of breed within portfolios. The final area that's also a tax-deferred account are annuities. Annuities have come and go in terms of popularity. They tend to become, or they have been more popular after the '08 recession because of all of the guarantees that they offer within those. I'm not finding quite as many people excited about them today. Annuities are not a big piece of our business. I'm not a big fan of the expenses that come associated with annuities. However, they are getting better. So sometimes, or when we're looking at these, I'm happy to see that they've been reducing these expenses, and they've also started structuring annuities that don't have commissions with them for independent fiduciary advisories like ourselves. So that's been a good sign. I'm still not on the bandwagon of annuities, but they are getting better, and I could see that maybe 5, 10 years down the road, maybe they're on par with some of these taxable accounts, which strip out a lot of the fees that are associated with annuities. Within taxable accounts, this is a standard brokerage account, non-retirement account. You can invest in stocks, bonds, cash alternatives, mutual funds, ETFs. There's a whole bunch of different products. But when you have all of this stuff, when you enter retirement, you start to look at this and say, okay, well, we need to replace our wages because we're now entering retirement. And which ones do we touch first? Which ones do we go after? And I'll touch on that in a second. Social Security, it's another one of these three-legged stools for income sources. Used to be 4 with the pensions, but Social Security is one of those legs in the retirement income story. For people that are entitled to Social Security, you have to have 40 credits, which is about 10 years of working in a job that pays Social Security taxes. You can start Social Security benefits anytime between ages 62 and 70. It's nice to have flexibility, but where flexibility comes in, there can also be confusion as to how and when you turn on these. We call these claiming decisions and optimizing your claiming strategies. If somebody's going to turn on their benefits at age 62, they're going to receive a reduced benefit. They can receive the full benefit when they're between the ages of 66 and 67, and that does depend on your year of birth. That's what determines whether you're 66 or 67, and then there's also variations in between that. So when we look up somebody's full retirement age, it might read 66 and 5 months. that's the month that they would be entitled to receive 100% of their Social Security benefit. And if you're fortunate enough to be able to delay that benefit, or maybe you worked until age 70, then if you waited to turn your Social Security benefits on until age 70, you get 132% of what you were entitled to at your full retirement. So said simplistically, if I'm entitled to $10,000 here, I could get $13,200 if I delayed, and that would be a benefit that I would continue to receive for the rest of my life. Or I could receive $7,500 if I turn the benefit on at 62. So you can see there's about a $6,000 spread in that example right there. So there is an incentive to delay. Not all people can delay though, because you have, if you're going to delay, then you have to have something to supplement your income while you delay. Not a big deal if you're still working, but if you're retired, it becomes a harder question to ask. Should we start depleting assets, or should we turn on Social Security earlier than age 70? And then married couples and surviving spouses also have some other choices to make. My colleague Dave wrote a great piece. It's on our website. I'll show it to you actually. It's pretty cool that I can do this. So right on our website, stonehearthcapital.com, if you go under white papers, you can see the paper that I just wrote for this presentation that we're doing. And then you can see optimizing Social Security. And the way that he wrote it, you can go into the category that pertains to your situation and look up what the rules are, which I think is pretty cool. The next area here, still sticking with Social Security, this just graphically shows you that for each year, 62, 63, 64, this presumes that this person's full retirement age is 65 when they're entitled to 100% of their own worker benefit, and they could receive up to 132% if they waited until age 70. If you're entitled to spousal benefits, just something to point out, that if you turned on your spouse's benefits because theirs happen to be higher, or maybe that's usually the primary driver. There's a couple of other scenarios, but you would only get 35% of their benefit. So if they receive $1,000 a month, you could receive $350 a month if you turned it on early at 62. If you waited until 66, you could turn it on and earn 50% of what they're receiving. So again, if they're receiving $1,000 a month and you turn it on at your full retirement, then you can receive $500 a month. Social Security is anything but simple, unfortunately. So this really is a customized or personalized analysis that needs to be done for each family to determine what is the best claiming decision. It's an area that we've been working on for a long time, so we're very comfortable in this area and help families navigate this. Simplistically, and I'm not always a big fan of this chart because it undermines some of the other complexities that come into the claiming decision of when to turn on Social Security, but simplistically we can see that if somebody turns on their Social Security benefit early, or at full retirement, or at age 70, you can see that at age 70, the slope of cumulative money that you've received, the monthly income stream, it should be higher, and so the slope is stronger. And you can see at some point right around age 80 to 83, there's this intersection between when somebody turned it on at 62, 66, or 70, where, you know what, it doesn't really matter which one you elected. And then if you do live past age 83, 84, 85 into your 90s, you can see that you would have been better off and received more money if you had delayed until age 70. This is the case. This is often the case. However, it does undermine the tax ramifications and the impact on your portfolio. So if you do delay until age 70 to turn on your benefit, that means you need to supplement your income. If you're working, that's fine, but if you're not working, you need to get that income from your portfolio. So you have to draw down your assets while you delay Social Security, when we build a financial plan, it has all of that math taken into consideration, which I think is a much more accurate way to analyze Social Security benefits. But just simplistically to show people there is a point where these things intersect, and usually people benefit if they can last 85, live past age 85. They're usually, at least to have one spouse delay their benefits until age 70 is typically preferred. But everybody has, we have to also imagine people's views on longevity or their family history for health. One other point that I want to make is Social Security is taxed at the federal level. Here in Massachusetts, they do not tax Social Security benefits, but at the federal level, they do. And one of the things that you need to remember is dependent upon whether you're a single filer, tax filer, or a married joint filer, when your combined income threshold, which they have a quirky way of calculating it down below, just know that if your income is between a certain range, then 50% of your Social Security benefit will be reported and taxed on your tax return. This does not mean that the tax rate is 50%. This just means that 50% of your Social Security will be reported on your tax return. If you look on your tax return next to Social Security, if you're already receiving Social Security, you'll notice that there's two line items. It shows you what your total Social Security benefit is first, and then second to the right of that, it tells you how much of that is taxable. And it ranges from 50 to all the way up to 85% if your income is above 25,000 or 32,000. And once you hit over 34 or 44,000 of income, then 85% of your Social Security is taxable. So for example, if your Social Security is $10,000, you'll see $10,000 on your tax return on the first line item. On the second line item, you'd see $8,500 as taxable income. That would be taxed at your normal tax rate. This is a little surprising to me, but it is a 2017 study. 79% of workers expect to work in retirement to supplement their income, but only 29% of retirees actually do it. So just recognize that if you're going to retire and maybe start working as a pensioner, maybe start taking a side job, part-time job, just recognize and be honest to yourself whether you're really going to do it, and just recognize how important is your financial plan, how important is that continued employment earnings in terms of the success of your financial plan. Do I really need that, or is it just gravy? Sometimes the choice is made for you for health reasons where you cannot work, and just recognize that as well, that there is a risk that even if you want to work in retirement at a part-time job to supplement your income, you might not have that option because of health reasons. The next area that we're going to spend some time on is distribution methods. This takes a look at, well, all right, well, how should I calculate? What's an okay amount for me to be taking out of my portfolio? So first, let's look at the impact of rate of return on a portfolio. If you have a $500,000 portfolio and you're taking $50,000 a year out of the portfolio, keeping things simple, you would think, well, if that portfolio didn't grow at all, then I have 10 years worth of withdrawals that I can take. But if the portfolio grows at 4%, and more realistically, 50,000, I'm going to need to take out a little bit more each year because of inflation, then you can see that it lasts a little bit longer than 10 years. If you're able to get an 8% rate of return while still taking out the same 50,000 inflation adjusted, you can see that that lasts about 14 years. Now, when I look at this, I actually think to myself, well, that's not a real big spread between this, 10 years versus 14 years. And you've got to be taking a good amount more risk to get an 8% versus a 4% rate of return. So, there's different ways to look at this. If I were looking at this scenario, this 8% could actually backfire on you because markets, if you're taking more risk, this could easily sell off more rapidly. So this isn't necessarily a great case to look at, but it does point out the fact that rate of return does have an impact, as you would expect. We've probably all heard of the 4% rule. I read it in financial journals. that, okay, if I'm going to retire, then I can afford to take out 4% as a general rule. Well, what they don't tell you is that really is supposed to be for someone like 60, 65 years of age. If you're going to retire early, you can't afford to take out 4% because you're going to need to take it out for a much longer period of time. And at the same token, somebody that's 75 and they decide to retire, if they're using that 4% rule, they're going to die with a whole bunch more money than they thought they had, than they thought they were going to have, because people that are older can afford to take out more money because their life expectancy is shorter. So it's not a perfect rule, but it's a starting point. It gets the conversation going. There's then the endowment method. Just think of Yale or Harvard. They don't need to increase the draw from one year to the next, because an endowment, the university, it's not really getting older and needing more money. To some degree there is, because inflation still is out there. But what an endowment does is they typically look at, because there's no end date, endowments don't die, universities don't die, so they can't. Their goal is to not touch principal. They always want that thing to continue to grow indefinitely. So they'll usually look at taking 4 or 5% every single year forever, and that's really what they're expecting, a static number. And then there's the distribution periodic tables. These are things like required minimum distributions, where the government has a calculation that says, while you're younger, take less money, and while you're older, we're going to force you to take more money. And that's probably the more appropriate approach. If somebody was going to pick these, I'll actually talk about one of the other ways that we do it. I prefer to use what's called systematic withdrawals, and that more closely resembles this distribution periodic tables, where we take people's ages into consideration for how much they should take from their portfolio. So a common question, what to spend first? So as a general rule, we spend taxable accounts before we spend tax deferred. Why? Because tax deferred, it's nice to defer or delay that tax liability. However, when you turn 70 and a half, the IRS comes in and says, well, you need to start taking money out because we've never taxed you on that, and we want some tax revenue coming in. So there will be a point in time where you have to start taking money out of the tax deferred. But as a general rule, we like taking the money out of this taxable account because most of the taxes have already been paid already. You might have some capital gains that you got to deal with, but that's not as invasive. That's not as big of a hurdle as compared to when you take money out of a tax deferred account, where 100% of whatever you take out is taxable. When you take money from a taxable account, only the profits are taxable. As a general rule, we'll take winners before losers. This is part of our rebalancing process. So if you need to generate income and it's $5,000 a month, whatever that magical number is from your portfolio, when we raise that $5,000, we automatically will look for the winners to trim, because the winners are closer to falling outside of our brackets. Each asset category for us has guardrails, and they need to stay within those guardrails. And if something happens to be doing well, it's closer to piercing the upside of that guardrail, which means that they've been doing better than some of the other positions in the portfolio. And I'm a big fan of taking winners. Now, sometimes if it's done in a taxable account, that does result in taxes. So we have to be careful of that, which is why we look at tax loss selling throughout the year to try to find some positions inevitably lost money during the year, and we look to capitalize on those to offset the tax liability that we realize from the winners. One of the things that you got to pay attention to, and I'm dealing with a couple of cases right now where we're dealing with this specific scenario, where if you've got highly appreciated asset, what that means is you put in $100,000 into a position and it's now worth $1 million. And if you were to sell that, you'd have to report $900,000 in profit. When you're looking at that, you have to gauge and weigh the pros and the cons, because if you sell that, you owe tax liability. And while that's nice, you can then diversify it into other asset categories or spend it or do whatever you want with it. You're going to walk away with less than that $1 million because you have to pay taxes. The flip side of that, though, is if you're older than, I'm going to throw out an age of, say, 80, or your health is not good at any age, then what you have to recognize is that when you pass away, your heirs, whoever you leave that asset to, will not owe taxes on that. So in that scenario of investing $100,000 and it grows to $1 million, your heirs can sell that the next day after they inherit that for $1 million, and they don't owe any taxes on that. That's known as a step up in cost basis. So you do have to be very careful if you or your parents have these highly appreciated assets that have been very successful at trimming those, especially if they're older of age, because you have to be cognizant of this step up in cost basis rule. So sometimes we will purposefully not touch those assets, sort of accept that concentration risk in that security because we're so concerned about the taxes. It's usually a pros and cons analysis. So there are three major distribution options. This slide is really looking at it as if you're taking money out of a 401k, but it could also, the same scenario applies when you're dealing with IRA accounts. So one option is to stay put, but we're going to kind of ignore that because we're going to presume that you need to generate some income from your portfolio. So one option is to just, hey, Jamie, I want to go buy this nice boat. It's $300,000 and I want to withdraw my entire 401k or IRA account. And we are then going to pay cash for that boat. Well, the challenge there is whatever you take out of your retirement account to pay for that $300,000 boat, you might need a $500,000 IRA account because you're going to net after taxes $300,000 to actually pay for that boat. That boat now costs you $500,000 of assets to buy that $300,000 boat. So that doesn't usually make sense. It depends on people's finances, but it doesn't usually make sense. So if somebody said that they wanted to do that, I would most likely say, you know what, get a loan on that and we'll start taking monthly withdrawals to pay for the loan on that boat. Or we could even look at lifetime annuities where you give an insurance company a block of money, a piece of your portfolio, and by contract, they promise to pay you an income stream for the rest of your life. For example, if you give them $100,000, they might agree to pay you $6,000 for the rest of your life. They use your age as the primary determining factor as to how much they're willing to pay you for the rest of your life based on you giving them $100,000. If you're young, they're going to only pay you $3,000 or $4,000 a year. If you're older, they may be willing to pay you $7,000 or $8,000 a year. They have a role, but it is giving up access to that money. It is basically creating a pension of your own. I do like that idea, and the financial journals are starting to show the merit in doing that. However, at today's low interest rates, I think it's a big pill to swallow, so I'm not as eager to do some of this, but that may change as soon as interest rates continue to rise and hopefully get maybe 5, 6, 7%. Well, then the insurance company is going to, it'll look more appealing because they should be willing to pay me stronger income. So maybe in my example, I give them $100,000, and maybe instead of $6,000, maybe they are willing to give the same aged person $7,000 or $8,000 because they're getting more money with that $100,000 that you gave them because they can invest that and get better returns. Systematic withdrawals is probably our most popular, or it is our most popular. And this, we look at what you need after Social Security or pension or some part-time work. And if that's $5,000 a month, that's $60,000 a year. And we always analyze that draw against your portfolio size to make sure that that's a sustainable amount long-term, a sustainable distribution or draw. And we just manage that on a monthly basis where we send that to you. And it's made up of dividends, it's made up of capital gains, and sometimes it's made up of principal. It all depends on what's going on in the portfolio. But all of those sources come in to be able to generate that $5,000 a month of income. As I mentioned, the appeal of lump sum is that you get immediate access to it, but the downside is that you've got income taxes that are due. Systematic withdrawals, you could say I want to receive $3,000 a month. You can say I want to receive 4% of the account value. And then there are other ways that you could do it with a total account value where you say, okay, I've got $1 million here's the chunk of money that I'm going to receive for the next 10 years. Go ahead and send me 1/10 of that for the next 10 years. And usually income streams, just like when we're working, usually come out monthly. I think most people are paid weekly or semi-weekly. Some people are even paid monthly. When you're retired, Social Security pays monthly. Most pensions pay monthly, and so do most portfolio systematic withdrawals. But we can really handle quarterly, semi-annual, or annual withdrawals as well. Here's an example. Roughly, this would take about $200,000 to give to an insurance company to get a lifetime income annuity, which means you give them $200,000 and they're willing to pay you $1,667, which is about $20,000 a year for the rest of your life. If you pass away, your spouse gets nothing. If you want your spouse to get whatever you're receiving, well, they're only willing to give you, because now the insurance company, you always got to think, what are their risks? They're going to now give you only $1,100 instead of $1,600. Why? Because they got to continue that payment over your spouse's lifetime. And as we saw earlier, the chances that that one of you is going to live a longer life expectancy is growing. So the insurance companies recognize that. So this is what it's going to cost you to add a survivor benefit. And if you only want your spouse to receive half of what you would get through this annuity, then it's not quite as big of a reduction. Now, one of the things that you could do, and one of the things that we've structured for families, and you have to be insurable to get a life insurance policy to do this, but we've structured it where we say, all right, in the best case scenario, you get $1,600 a month. That's at least going to generate the largest amount of income, but it subjects your spouse to some risk. That's quite a bit of risk. Hopefully there's other assets available, but this goes away. Or the worst case scenario for you is $1,100, but your spouse would at least get something. Well, what we've done is taken this $500 of delta per month, which is about $6,000 a year. We've elected this option and got a life insurance policy on the person that's receiving this, and you just don't want to spend more than $6,000 a year on that. And what it would do, is if they passed away, it would provide a lump sum that's available for the surviving spouse. So there's still something for the surviving spouse, and if you ever decide that you don't need the life insurance, you can cancel it, and you're still getting the largest payout. Graphically speaking, here's somebody, will say that she's collecting the income stream. If she passes away, the surviving spouse gets nothing. However, if you do a life insurance policy with this, we can have her turn on the highest benefit. We purchase a life insurance policy. Oh, sorry, hit the wrong button. We purchase a life insurance policy so that it covers, I guess they did this example in the reverse. But there's a life insurance policy that's going to be paid out to the surviving spouse. So it's a good compromise there for somebody that wants the largest benefit and wants to control that and is willing to use up some of those savings to go ahead and purchase a life insurance policy. So which distribution method is appropriate for you? And these are the factors that we use when we analyze this stuff. We look at people's ages. We look at their liquidity needs. How comfortable are they with market volatility? If somebody really doesn't like market volatility, just think of the pension as a good route. Today, I'm not a huge fan because low interest rates, but at some point that might not be a bad option to use some of a portfolio to go ahead and purchase your own pension. What kind of income needs do people need? And then also we got to take into consideration tax situations. The third area, distribution rules. Distribution rules are obviously important. If you retire, if you're fortunate enough to retire early, just remember that if you're under 59 and a half, there's a 10% penalty whenever you take money from your retirement accounts. You can take money from a taxable account but without penalty, but you will owe a penalty if you take money prior to age 59 and a half. Now, there are exceptions. So I've got some clients that have stopped working early, not because they wanted to, but because they became permanently disabled. There are some other exceptions to these rules. I don't want to spend a lot of time on this, but just know if I retire early and I need to supplement my income from my portfolio, if that includes retirement accounts, I really shouldn't touch those, plan on touching those until I'm 59 and a half, with some exceptions. This goes into more details on one of the exceptions. Just in the interest of time, I'm just going to keep moving forward. I do want to point out another rule that people have to be aware of. I mentioned it, is required minimum distributions. One of the things that we've agreed to do, I'll show you this. Amanda just put this on. We just put together our list of webinars for next year. So again, if you come to our website under resources and webinars, you'll see that right now we're doing the essential strategies for a successful retirement. You'll see next month we're doing divorce. Then Chris's our chief investment officer, Chris, is doing a quarterly update. But notice here we're doing an entire presentation just on required minimum distributions. We thought it was appropriate because that is one of the most common questions that we receive from families. So we're going to be dedicating an entire presentation or webinar just on that, along with some strategies that people need to think about and some rules that people need to take into consideration. So what is it? When you turn 70 and a half, any money that sits in a 401k IRA that hasn't paid taxes on yet, the IRS wants some tax revenue, so they put in these rules that said starting at age 70 and a half. It's weird. I know it's 70 and a half. I know they just added that to make it more complicated. You need to start taking out some of the money out of your retirement account. That triggers a tax liability. What you do with that money that you took out is up to you. You can either supplement your income, and if you don't need that money, then you could just put it into your taxable account. But it satisfies what the IRS is trying to accomplish. All they want to do is generate tax revenue. Mission accomplished with required minimum distributions. And I'm sorry, I didn't put it back onto the slide. Required minimum distributions, the first year that you turn 70 and a half, you actually have the option to delay the first year distribution until April 1st of the following year. It says after. Usually it's not a good idea to do that because then you need to take 2 distributions in that year. However, we have structured it that way for a handful of families because somebody's working until they turn 70 and a half, and it makes sense to not take their required minimum distribution that year and take 2 the following year because we were dealing with them still working. And then it shows how this is calculated down below. One important thing that we continually come across are problems with beneficiary designations. Usually it's not a problem for the primary, but we do see contingent beneficiaries missing. It's usually a good idea to name your children. If you do have children, I like the idea of naming individuals. That doesn't mean you can't name charities. That's fine too. You do need to you should talk to somebody when you name charities. You should talk to me if you're going to name charities, or one of my colleagues, because there are some rules that you need to be aware of when it pertains to stretch IRAs, which I have a slide on just to get your attention on that. You also need to be careful if you're going to name trusts as beneficiaries. Trusts, if not done properly, may not qualify as a valid beneficiary, in which case we can't take advantage of these stretch IRA provisions. Most attorneys are aware of this now and have actually put in language that specifies and draws our attention that this trust has been drafted in a manner that satisfies the 5 requirements, but it can be rather complex. So just make sure that we're addressing these things, or that you've looked at your beneficiary designations for all retirement accounts and usually life insurance. Those are the big ones that have beneficiaries. And if you have an annuity, that's another one that would have a beneficiary. Stretch IRAs, I don't want to spend a lot of time on this. Just recognize that if you do leave money, retirement assets, to your kids, that stretches the period of time that they have the option to defer or delay taking a withdrawal. Now, they still need to take some money out each year, but the bulk of the money gets to stay in there, and you get to stretch out the benefits of these IRA accounts for a longer period of time. Now, I get really excited. I was super excited about this when it first came out. However, I'm probably, I still like the idea, but the reality is that 80% of beneficiaries liquidate the entire IRA within 3 years of inheriting the account. So they never really get to flex the muscles of and the value of a stretch IRA, because the kids, whoever inherits this, just has other ideas with that money. But if you can utilize other assets to accomplish whatever it is that you're trying to do, maybe it's educate your children, pay for them to go through school. That seems to be a popular one. If you're fortunate enough to receive taxable accounts and you don't need to touch the stretch IRA or the money that you inherited from your parents or somebody else, it's amazing if you can let that continue to compound tax deferred. Fourth area, and the next two sections are going to go rather quickly. Develop an investment strategy. This is obviously something that my firm specializes in, and we've been doing this for over 35 years. The key, put together an efficient mix of assets. Really what we're talking about is asset allocation. Don't put all your eggs in one basket. You want to have a whole bunch of different colors here that represent different asset categories. Why? Well, because you might find some great opportunities, but probably more important to that than that is that if you have multiple colors here, it just makes it harder for this to break. And this is one of those risks that we have to be paying attention to. Having a diversified portfolio that's properly structured should have some assets that will make money when the market's going down. That's an important part of having a diversified portfolio. Here's just a sample of a portfolio that's conservative over the last 20 years. If it's got 50% in bonds, 20% in cash or alternatives, and 30% in stocks, you can see that its best one-year performance is up 16%, its worst is down 13%, and its average is 5.81. Now, these are numbers you can see who did this. These are not our portfolios. I'm not quoting any of our individual products or holdings. I'm just using another group's research to show you with this allocation what this portfolio has performed. Now, if you have an aggressive portfolio, you can see higher highs, lower lows, which is the risk side of things, hence aggressive, and the average rate of return is 6.85. This is only about a 1% increase for taking a good amount more risk. So, you know, since 2000, obviously we had two big recessions there that have presented and highlighted the risks. Obviously 2008 is in here. So you're not seeing as big of a delta between these two. But it does still show that even when we experience headwinds, that an aggressive portfolio, given more time, should hopefully outperform a conservative portfolio. But it's going to be a bumpy road at times. A tax-exempt investing, this is for people that are predominantly in higher tax brackets. So if you're even in retirement, if you're making $200,000, $300,000, $400,000, $500,000, $600,000 a year of taxable income from your portfolio or part-time job, pension, Social Security, if you are and you have assets that are in a taxable account and you want to have some bond exposure, what this does is this shows you the value of investing in tax-exempt or what we call municipal bonds. So if I can go out and get a tax-exempt bond or a municipal bond that's yielding 3% today, and I fall in the 24% tax bracket, I would need a corporate bond that was yielding at least 3.95 for them to be considered the same. Because corporate, this one here, the 3.95, I have to pay taxes on, which after a 24% tax bracket will equate to a 3% return. Now, the nice thing is if you invest in your own state, like Massachusetts, if you invest in your own state's bonds, which does increase the risk because you're only focusing here on Massachusetts, you can actually also avoid paying taxes at the state level on top of the federal level. So municipals are worth considering, but they're worth considering at higher tax brackets or higher income earning rates. If you're not earning $200,000 or north in retirement, then munis do have some other risks that are embedded in there that you just have to take into consideration. Final section, prepare for the unexpected. First, what are those areas? I'm going to highlight, there are other areas, but I'm going to highlight the top three. Long-term care, like what if you go into a nursing home or need somebody to come help you at home? The next one is health care coverage. We all should have good health care coverage while we're working. We usually get that through our employer. Once we retire, we usually get that through Medicare along with a supplement. And then the final area is what's called estate conservation, or what I more commonly call estate taxes, something that you got to be careful of. So let's take a look at long-term care. The average national nursing home cost is $97,000 a year in 2017. That's big, that's a lot. And obviously you can see it depends on what state you're in. It looks like Texas is a good place to be if you need long-term care or nursing home care. Whereas New York is going to cost you almost double. Here are your choices for how to pay for that, $97,000 on average. Well, you can self-insure, which means you're going to use your own income and assets to pay for that care. If you don't have assets to pay for yourself in a nursing home, then you rely on Medicaid. And then the final way to pay for nursing home or assisted living is to purchase an insurance policy, which is called long-term care insurance. We've been purchasing this for our clients for the past 30 plus years. It is expensive. The average policy for somebody that's 60 to 63 years of age is about $5,000. If you want a lot of bells and whistles in that policy and you want it to cover everything, then it's going to cost a lot more. If you want just a bare bones policy, then you can get it to cost a couple $1,000s. Usually we're looking at these policies for families that have about $1 million and greater, up to about $3 to $4 million. After that, we usually say that they can afford to self-insure if you have more than $4,000. If you have no money, you can rely on Medicaid, and long-term care comes into play usually at that $1 million to $4 million, where you're trying to protect those assets. Unfortunately, if you're under $1 million, the challenge becomes the cost of the insurance just becomes prohibitively expensive to protect that account, and it's a tough spot to be in. Health insurance, healthcare costs. You can see inflation here is in the green, and healthcare increases are here in the orange. And you can see that in each of the last couple of years, I guess with the exception of 2017, healthcare costs have risen at a faster rate than other general inflationary numbers. We use a 5% inflation projection when we illustrate healthcare premium costs or healthcare costs, just because it should and has a history of growing faster than the general rate of inflation. And the final slide is state conservation. Just recognize that starting in 2018, the federal estate tax, which is 40%, which is charged, if that's a rate, tax rate, on any estate that exceeds $11.18 million, and that's for one person. So if it's a family, you actually get $22 million, and they incorporated some rules about 3 or 4 years ago called portability. So just about every family is going to get roughly $22 million. Now just recognize that there is a sunset provision. So these are the rules up until the year 2026, where this $11 million goes back down to about $5.6 million. I think it's right in that vicinity. So that is scheduled to change. Trusts are still valid. There's still a lot of reasons to utilize trusts to help mitigate some of these risks, but fewer and fewer families are being faced with the federal estate tax. However, the state tax, at least in Massachusetts, is still alive and healthy. That excludes the first $1 million. And if you have assets that exceed $1 million, when you pass away, they're going to tax the whole thing. So it's an area that needs to be considered. It's an area that we spend a lot of time talking about with our families, and it's also one of the reasons that if you have greater than $1 million in assets, why trusts are still an important component here in Massachusetts. So talk to your attorney to see if you have estate tax sensitive trusts that utilize and make use of that $1 million exemption per person. It's beyond the scope of this presentation because it is rather complex, but it's an area that is a risk to people and something that you need to pay attention to. That concludes my prepared remarks. And Amanda, if you have any questions, I'm happy to take them.
Hi, Jamie. Thanks so much. Yeah, we do have a couple, but just as a reminder to our attendees today, just use your GoToMeeting taskbar and type in your questions in the questions portion, and we'll do our best before we run out of time to get to everyone's questions today. So the first one I have is, do all assets receive a step up in cost basis when I die?
That's a good question. The real answer is no. Retirement assets and annuities are the primary areas that do not receive a step up in basis. So remember in my example where I said we invested some money in $100,000 into a stock and it grew to $1 million. And if I pass away, my children receive that. They get to sell it for $1 million and not owe any tax. That only applies to taxable accounts. If that was done in an IRA account and they want to withdraw the IRA, the $1 million, that $1 million is taxable. So step up is only good for non-retirement assets, which does include homes.
The next question I have is, how does your firm generate income for your clients, and does it change over time?
Yeah, so I mean, it does vary over time because it depends on when people retire, when they're hitting, how close are they to age 70.5. As a general rule, we take cash flow, we generate their draw from their taxable account. However, what we have been paying more attention to over the last couple of years is actually the client's taxes, to see if there's a chance to convert some of their IRA over to a Roth, because we're finding that more and more families are artificially low. They retire and they're maybe 65 years of age, and they're going to supplement their income from their portfolio, their taxable account, and we're finding that their tax bracket is really low because they're doing that, artificially low. And then when they turn 70.5, their tax bracket's going to go up because they need to start taking money out of their 401k or their IRA. Because of that factor, what we're seeing is tax brackets are going up at 70.5, and we're wasting some of these tax brackets in the earlier ages. So what we're doing is either taking some money from their IRAs to push their taxes up to a point that we're comfortable with, and then taking the balance from their taxable account. Or a strategy that I like even better is take all of their cash flow needs out of their taxable account, like a personal account or a joint account, and then converting money from their IRA over to a Roth to artificially push their taxes up. And the beauty is we get more money into a Roth, which is a tax-deferred and a tax-free account going forward, as long as Congress doesn't change any of the rules.
And Jamie, just to respect everybody's time here, I think we've got time for two more. The first one is, okay, how are required minimum distributions, also known as RMDs, calculated, and what does it look like for your first year?
Good. So what they do is they use your age and they take your account value, your December 31st of the prior year account value. So if I have a $1 million IRA account and I'm 70 years of age, they use those two pieces of information, that I'm 70 and that it's $1 million, and they run it through a formula, and it spits out a result to tell us how much money you need to take out. For somebody that's 70.5, the factor is about 4.5% of that $1 million that they need to start taking out. It does grow, that percentage increases every year because you're getting older, and that influences the math. But it starts at about 4.5, which on $1 million would be about $45,000 that you would need to take out of your IRA.
And the last question I have is, if my children inherit my retirement accounts, what choices do they have with that account or with the accounts?
Yeah, with the retirement accounts, it's stretch IRA is one of them. So they can, as long as they're listed as a beneficiary on the account, which again is why that's important, they can stretch that and just take out required minimum distributions, which again, just like we're talking for somebody that's 70.5, if I'm 40 and I inherited my parents' asset, I still have to take a distribution out of that based on my life expectancy. So it would be a very small distribution, but I do have to do that. And then you can keep the money in there. The other option is to to withdraw it whenever you want. And we know that, as I said earlier, a lot of people withdraw it. And that does trigger tax liability. But, if they can afford to use other assets and leave the money in an IRA account, all the better.
Jamie, thank you so much. This was super informative and helpful. I hope it was for all the attendees. I just quickly want to go over next month's webinar. It's with our Senior Financial Advisor, David Giuliano. It's titled Thinking About or Recently Divorced, Think Financially, Not Emotionally. You can just head over to our website there and click Register Now to register. Please feel free to forward that to anyone you may know who might be going through something like a divorce. I think it'll be really helpful. And also, we're getting ready to roll out our 2019 webinar calendar. Our webinars have been super, super successful thanks to all of you attending. So thank you so much. Make sure to watch out for that email. Hopefully, we'll be sending that out in the next couple weeks. Again, Jamie, thank you so much, and hope you all have a wonderful day.
Thanks, everyone. Take care.